Hello everyone, it is Sunday, September 12th, and this is episode 30 of Odds Are, your S&P 500 weekly market forecast. Alright, let's start by taking a look at last week. So, last week I admitted that the week before, even though I thought that we were going to breach the lower breach point, we did not, but I still held that position going into this week. I said, even though last week did not breach the lower breach point, I still believed that we were going to breach the lower breach point in this week. And I mean, just looking at this chart, you can tell that we definitely did breach that 4509 lower breach point. We breached down to the downside, we passed that red midline of the Bollinger Band, and then we still settled within the expected settlement limit or range and did not even come close to the parabolic SAR. All right, so that was last week. Also notice we kind of came close to breaching that upper breach point. We almost had a double breach, but we went up, hit some resistance right there, and then just, went straight down. Now, for those of you following the markets, I'm sure you guys know, there's some fundamental, like some news behind that. But, when we look at this, we're not looking at the charts and trying to like align that with the fundamentals or the news. Like, we look at the price activity because for those of you that believe in technical analysis, you believe that the price action is as much of an indicator of or reflection of the current events as the fundamental news itself, because it's all baked into the price. And so the people that are in the know, the big, hedge funds and money managers that are paid handsomely to stay on top of all these events, are going to take the appropriate action. And so as soon as they know it, their positions are going to change or reflect that, and then we see it in the price. So the actual change or the difference between when the fundamental news breaks and the price action reflects it, as technology has advanced, it's gotten smaller and smaller and smaller. So since we're not, trading, high-speed trading, we don't need to be, seconds ahead of somebody else. We're just looking, at the week going forward. But I'll just get off my soapbox now. All right, let's take a look at the moving averages for next week. The short-term moving average has now flipped to neutral. We've seen this a couple times in the last 2 months where it's gone from bullish to neutral, then back to bullish, then back to neutral, mostly on the bullish side. But is this one different? I don't know. We'll see. I will say that when we look at the chart again for next week, we'll see that there were a couple of times in the last couple months where we did have a dip that was significant enough to get the short-term moving average into the bearish camp, but it never held, and we never flipped the medium term down to neutral or bearish. Definitely not the long term. So, but this is again just one domino, so let's see how far the rally, or the negative rally in this case, goes. All right, next thing, we're going to take a look at what we are expecting for next week. So your lower breach point for next week is going to be 44.24 with an upper breach point of 45.16 and 81.28% chance or odds of breaching one of those 2 points. Our expected settlement range is between 43.31 and 45.31. And then this is very interesting. For the first time in a while, our parabolic SAR is now actually within the expected settlement range. Now, it's not much of a window. It's only 8 points, right? So for this to really have any meaning, we would have to close below 43.39, which is possible, right? Because it's a 79% chance of closing within the expected settlement range, which means 21% of the time we don't close within the expected settlement range. So we could very much close below 43.39 and below 43.31. But in order for both of those to be correct, we'd have to be right in that little 8-point sweet spot. Doesn't mean anything like, crazy. It's not a huge red flag, but it is a warning sign, because if that parabolic SAR is creeping up into this expected range, it could mean that we're forming a top. And I mean, I know the last couple of days have been red, but when you look at the grand scheme of things, I'm talking like looking over weeks and months, we could be forming a top here where that parabolic SAR is finally going to peak out and is creeping into that range, and then we close below it, and then that's where we start really having that bearish sentiment. So it's just something to keep in mind as we flip here into the relative view. And so you see where we're at. We close below the red midline. the parabolic SAR, you see there in yellow, now it's above the green line. The range, I mean, it's wider than it was in the last 2 weeks, but that's because we had, some increased volatility. And then the settlement range, the lower settlement range, way below the lower edge of that Bollinger Band, and then the upper one is within the Bollinger Band. So all in all, I mean, I think at this point we kind of pause, because I don't think that there's a directional bias for one of the breach points or the other. And I say that as we get into our next section, didn't see that one coming. So what I'm saying that we should not allow ourselves to not see coming, right? So we must be vigilant about this, is I'm going to pull up this chart again for the relative view for next week. Now, notice that we had our streak of red days. We crossed that midline. Now, the last 4 times, that's not enough of a significant sample to base this off of. But just look at the pattern. Look at how we crossed the midline all the way to the left, in the bottom left hand of the screen. We crossed the midline, went down, actually breached the lower Bollinger Band, and then bounced back up. Then again, went down past the midline, reached all the way down, almost to the edge of the Bollinger Band on the downside, and then bounced back up and crossed above the midline and kept going. Then we did it again. So that does not mean that's exactly how this is going to play out. But it does mean that we have to be very cognizant of the fact that the last 3 times we breached that midline, we ended up going down to the area, lower end of the Bollinger Band. Sometimes we breached it, sometimes we didn't. We kind of just flirted with it. But either way, you should not be surprised at all. You cannot say you did not see it coming if this week we end up going down towards the lower end of the Bollinger Band. So if we were to breach that 44.24, right, and that's perfect right there, because that 44.24 lower breach point is just enough to get us close to that Bollinger Band. I mean, and we could breach it obviously with a little bit of strength, since we know that we breach with more strength to the downside, and then we could have a spike up. Or maybe it's one of those things where we tested that 3 times, and this one's going to be the one that breaks the camel's back. We end up really going down and continuing to go down. But however it plays out, just kind of giving you guys the heads up, do not be surprised if we breach that lower breach point. We could rally from here and get have some of that residual support from the red midline, and then we can kind of stay there for a little bit. But that's just kind of my takeaway. All right, and then the last section here, quote of the week. So this is actually from a website. It's kind of like a blog site. They have different tips and tricks and things like that. I've seen some memes from them, and I mean, they seem to have some good stuff. Not advocating or putting an opinion one way or the other, but I did find some kind of interesting quotes from them. And this one says, "A trader looks for consistency, and the gambler looks for a quick profit." And that's from TradingWalk.com. I love this quote. It makes total sense to me, because if you can find a system, right, if you can find a pattern, if you can find something that you can trade off of consistently, that is way better than trying to just, throw money, put it all on black, and just hope that you make a quick profit. Now, real scary part is when somebody does that and actually makes a profit, because then that leads them to believe that they can do that again. I actually believe that taking early losses and having a rough start to your trading career is actually better, because it really hardens you and stabilizes you, so that you're not thinking, oh, this is easy money. So look for consistency. Don't look for a quick profit. Hopefully that helps some of you guys, and enjoy the rest of your week. Take care. I will see you guys here next Sunday.